So even though some participants are missing, I will start the call and welcome you again to our 9-month earnings call from Basler. My name is Hardy. I'm CFO, COO of the company, and I'm very happy to present you today new records of our top line and also very high growth rates for the third quarter, and also giving, let's say, you a more clear picture in these turbulent geopolitical and economical times. After making this note here of the disclaimer that we are I'm doing forward-looking statements that we can't be liable for, I would like to switch over to the agenda. It's a standard agenda that you are used to from former calls. We start with an executive summary, giving you the big picture, followed by more specific financials. Then a quick glance at the share performance over the first 9 months. And then we come to the outlook. And last but not least, we will then have approximately, I would say, 20 to 30 minutes time for Q&A. So starting with the executive summary. First of all, the environment. So the market highlights here, the industry. So the year-to-date German industry for vision components grew single digit, in billing 6%, in bookings 8% in the first 9 months of this year. The chip supply has recovered over the course of these first 9 months, and the market situation is definitely changing. The market demand has been cooling off since Q2. I mentioned this already in the last call, and the lead times are still high, but they are shortening. We see that particularly capex investments in the that are related to consumer electronics has been weak and remain weak, and Asia, specifically China, has been mostly affected by the slowdown. And what we also see is that the consolidation trend is ongoing, so we see M&A transaction happening, and we are part of it. When we come to our performance within this market, maybe first of all, we drive the consolidation trend at the moment. As you know, we have acquired, or we closed 4 transactions over the course of the last 9 months. 10 months, we acquired 2 of our Korean distributors, 1 of our Italian distributor, and we went into a joint venture with our French distribution partner. The post-merger integrations are ongoing, and we are very satisfied with the progress of the post-merger integration, and also especially on the Korea side with the financial numbers. Korea has been consolidated over the whole 9-month periods. Italy is only in the numbers consolidated in the third quarter. So our fast organizational growth, we continued that with 150 additional FTEs that we increased over the course of the first 9 months. Roughly half of it came from the acquisition, another half were organic hires and replacements. Our bookings were down by 12%. I come to this more precisely later, but we see definitely lower demand in Q3. We see cancellations happening. We see reduction of order horizons because of improving supply. But I will mention, or we'll dig into this deeper in the second paragraph of the presentation. Our billings over the course of the first 9 months were up 25%. Even the third quarter was up about 50%. Our order backlog, due to the high billings and slowing down bookings, shrank, but we are still on a very high level with approximately 124 million. This is approximately twice as high as normal, so the backlog is considerably high, still high. The gross margins and earnings margins bounced back to solid levels in Q3 after a temporary weakness in Q2. And the year-to-date earnings before tax margin is around the upper end of our guidance. It was at 11.8% over the period of the first 9 months. We recently, you might have seen this, increased our guidance, so we are very confident for the remainder of this year. Yeah, here you can see the organizational growth. The picture is we had approximately 900 full-time equivalents on board when we started the year, a little bit over. We were at 1,065 employees by end of the third quarter. We continue our hiring program, so we get several new employees on board until the end of the year. So we will approach approximately 1,100 full-time equivalents by end of the year, a little bit less. And this is a mixture of organic growth and 70 people that we got on board in Korea and Italy due to M&A transactions. As you can see, the split has not much changed. Worth to mention is the high spending level on R&D. 26% of our employees, of the number of full-time equivalents, is working in R&D, and this was in the first 9 months approximately 25 million euro that we invest in R&D. We significantly, or we not significantly, we increased the portion of sales and marketing employees. This is mainly due to our acquisition in the distribution channels. From a product launch perspective, yeah, we are doing a lot, quite a lot, increasing our portfolio, firing the transition from, let's say, a single component to a full line provider. In this endeavor, on this journey, we increased our lighting portfolio significantly. So here about 200 new lights. So quite a high variety of lights, also smart lights that has certain synchronization functions between the camera and the lighting itself. We also launched a full new line of ACE2 cameras equipped with the latest generation of 5 gigabit Ethernet interface, so a higher bandwidth, so that the cameras can transmit higher frame rates and or higher resolution images over the very famous gigabit Ethernet connectivity. And on the higher end product line, we increased the number of boost cameras and fitting frame grabber technologies. This is what you see in the lower part. So here we talk about very high resolution, very high frame rates that are connected to special pre-processing cards like you see them, and where we already pre-process the images before they are finally processed in the PC. We are investing heavily on the software side, in what is called Pylon Software Development Kit. Also recently we made big announcement here that Pylon is not only a frame tool any longer, so that connects the camera to the application or can connect different components with each other. We also now offer the so-called B tools. These are image processing algorithms that the customer can use within Pylon. You see some examples on the left-hand side, for example, on the pharmaceutical side or on the with the PCB board inspection. So there are analytical tools also available now, and Pylon is becoming, let's say, the central part of our offering. For our client, which is typically the R&D engineer at an OEM machine builder, these engineers can work with Pylon as the main API or software development kit, and around Pylon there are many different hardware products that can be easily connected and integrated by the customer. We recently showed all the new products and also our a nice journey towards a full line provider on the Vision Show in Stuttgart under the motto of Accelerate Your Vision. And I do have a video with me just giving you some impression how we presented ourselves, because I think it is a very good demonstration of our journey from single component to a full line provider. We demonstrated a lot of components in interaction, in applications. We connected different components. We showed the new software, as you can see here recently. And the resonance on the feedback on the customer side was very good. We were very satisfied with the show. And I'll let you watch the video here and get some feedback how our products are integrated in solutions. So having this shown, I'm coming to the second part of my presentation, financials, and I will start with the picture of the bookings and billings, and this certainly needs some further explanations. So first of all, this from a big picture here, what we are seeing is the bookings and billings and the ratio of those are changing. We come from 2021 where we had very high booking levels, and due to the chip supply, limited revenue levels. So we had very high book-to-bill ratios, and the picture started to change beginning of this year, and especially in Q2, where we had kind of a tipping point where bookings and billings were more or less equalized. And in Q3, the picture is changing. We have a negative book-to-bill ratio, and there are normalization and corrections happening. So looking first at the blue bars, so our revenue stream. What you can see is we were, due to the better supply situation, we were able to continuously ramp up our production and increase our sales. So up to a level of, in the last quarter here in Q3, 74 million, so which is actually roughly a 50% growth rate compared to Q3 the year before. So what is also can be seen is that on the booking side, if we look at that, the high level of bookings stopped in Q1, and then it went down. And we see now the correction happening of a very high book-to-bill ratios and very high backlogs over the course of the periods until Q2. What we have done to give you better transparency is that we show you here and give transparency of the orders that we have received already back in the calendar year and business year 2021, and that were canceled due to the fact that customers need to wait too long because of the chip shortage. So we show, because normally these bookings would be negative and you would just see the total result. But we decided here to give you insights, because actually this gives you a better insight on the real booking level, because the cancellations that you can see are from very old orders, and these are more cleaning up of the systems than recent business situations. But what you can see, even by doing that, we had relatively weak bookings of 50 million a quarter. So the situation, if you compare Q3 2022 and Q3 2021, is kind of the opposite picture. high revenues but low bookings compared to high bookings and low revenues in Q3 the year before. All in all, this is no surprise to us. I gave you already insights in the last call and also in the Q2 report or half-year reporting that we definitely foresee now a phase of normalization happening, and we see this happening. We see that the raw demand is lower. We see corrections, so cancellations of old orders, and we see postponements of orders and longer and shortening of order horizons from our clients because our delivery performance is getting better. All in all, we still sit on a relatively high order backlog of 124 million. I mentioned in the beginning of the call, this is roughly twice as high as normal. So normally we would have a booking level or a backlog level of approximately 2 to 3 months. That is kind of our normal lead time, but we have a backlog at the moment or by end of Q3 of 124. So looking at the regional split of the revenue, so in total 205.2 million euro. So this means 25% growth, and the majority of the sales has been achieved in Asia, 56%, then EMEA 26%, and Americas 18%. When we look and zoom in a little bit into Asia, there is a very mixed picture. China, which is normally our, let's say, growth driver, was pretty weak over the course of the first 9 months, especially in Q2, Q3. And we were able to compensate this by higher growth in Korea. So we definitely see here that the COVID situation, that the high exposure to consumer electronics in China, also competition situation is a situation where we see under proportional growth or even decline within the first 9 months of this year. Whereas in other regions, we see a nice growth. So looking a little bit further down the P&L on the gross profit margin and the absolute gross profit. So here we come back to our normal levels. This is good news. As indicated, after the special effects of the M&A transaction, after special effects of higher pressure from spot buys and later kicking in results or impact from our own price increases, we see now that our gross profit margins get back above the 50% line. So our operating level between 50 to 55, we are getting back to this, and we had also a record in gross profit and absolute gross profit in the third quarter with 38 million euro. So this also means then for the earnings before tax and earnings before tax margin, after a weaker Q2, we are back in very sound levels here, closely to, again, 13% earnings before tax margin, and overall here also with 9 million in earnings before tax, absolutely in the third quarter. Again, a strong value. Yeah, if we sum it up, the main KPIs of the P&L for the first 9 months, so order entries minus 12%, but still high level, 209.7. So sales 205, 25% plus. So this means that we have a slightly positive book-to-bill ratio over the course of the first 9 months. However, you have seen that the trend is definitely going in the direction of weak bookings. I come to an outlook in the last portion of the presentation. Gross profit also increasing by 17% to 102 million euro. Gross profit margin over the course of the first 9 months due to a weaker first half year, 49.7, but close to 50, so this is a decline. EBITDA, EBIT, and EBT are all on the same level compared to the year before, or the first 9 months the year before. So you see the effect here. We have increased the organization on the one end. On the other end, we have also increased sales, and the net effect is equaled out more or less. And the net income is a bit higher, 19.2, so the tax rate were a little bit lower. Earnings per share is 64 cents versus 62 cents for the first 9 months. Let's have a look at the cash flow. Here you see that we are in the situation that we have strong, let's say, negative free cash flows. They are mainly influenced by 2 effects. On the one hand, all the acquisitions, so 2 acquisitions in Korea, 1 acquisition in Italy, 4th JV investment in France. This is the one effect. The other effect is due to the high growth and due to the very challenging times on the supply side, we increased significantly our working capital. So the increase in accounts receivables and the increase of the inventories together is about 35 million euro. So this is also the reason why the operational cash flow in the first half year, or in the first 9 months, especially the first half year, was relatively weak. But now it's getting better. So the increase in inventory was much lower in Q3, but we are still having, due to the very high billings, high increase in accounts receivables in the third quarter. For the next quarters, we foresee that the cash flow will be much stronger because we don't have special M&A effects, and we will also have a reduction of working capital due to better supply, and also due to the especially cashing in the accounts receivables that we have built up due to the very high billings level. Yeah, looking at our cash flow and our cash account and also the net cash situation, to give you some insights here. You know that we work normally on a relatively conservative net cash or net debt position. Looking first at the development, we started the period with a cash account approximately of 55 million due to the weak cash flow in operations, due to the very high investments, especially on the M&A side. We had a strong negative free cash flow in the first 9 months of 38.6 million. We increased our bank loan, so we have a positive effect on the cash flow from financing, and we ended up with a cash account by end of September of roughly 24 million. On the right hand side, you see our net cash or net debt position. End of last year, we had a net cash position of almost 19 million euro, and due to the special effects that we were talking about, we are going through a high investment phase, and we run the company at the moment with net debts of approximately 32 million euro. Yeah, coming to the share development of the share price. So we started the year with very high share price of 53 euro. And we ended the period with 23.3. Today we are approaching 30 or around 30 euro. Over the course of the first 9 months. So in the third quarter, also to remind you, we did a share split, or actually we issued bonus shares. So we issued 2 bonus shares for every share that is in the market, which meant actually is divided then the share price by 3. And yeah, you can see that we, from a performance standpoint, more or less developed parallel to the market. But if we take the year, the beginning of the year, we are still underperforming compared to the TecDAX index. Yeah, then I'm coming already to the outlook before we start the Q&A session. So for the remainder of this year, we expect that the demand will still be weak. So the original demand, but we also see that the order horizons of our clients will be reduced because our delivery performance is getting better, the chip supply is getting better, and we also anticipate that at least in the fourth quarter, we will see also further backlog corrections from old orders, mainly from last year, but also from beginning of this year. We anticipate to continue our path of Q3 of sound production output, but we will still be limited in the production output by a few missing critical parts. We talked a lot about them, those parts in the last calls. On top of those parts are typically the so-called FPGAs, free programmable arrays, so the main processor and chips in the camera. So they are still short. There is a structural shortage still in the market that also will continue over the course, most likely over the course of the next quarters. We will also and have to anticipate limited sales in December due to a holiday season, but also due to this situation that we are changing, or we have plans to change from SAP R3 to SAP S4. So our very long and I have to say also painful and challenging project on SAP is coming to the go live. Therefore we will close a bit earlier the system, and we have only half December left for shipping and creating revenues. So then last but not least, I mentioned this already, the organization will further grow, and we see increasing OPEX and HR costs. They are all anticipated in our guidance. And the guidance is the one that we confirm here, our recently increased one. Revenues between 262 to 270 million, and earnings before tax in the margin in the range of 10 to 12%. This then will be a good milestone towards our midterm goals. Our 2025 goal to grow the company to 400 million euro at a sound profitability of 12%, and also a high cash conversion of 70%. So the free cash flow should be 70% of our earnings after tax, if we exclude M&A transactions. So the organic growth should be here also a strong cash contributor. Even though we see the challenges and the turbulent times in the markets at the moment, we see the geopolitical challenges, we are very confident about these 2025 plan, and the recent guidance increase of this year is also a step forward on this journey. Having this said, I'm coming to the end of my presentation and would like to switch over to the Q&A session.